Have you ever stopped to think about what actually keeps the wheels of commerce turning when the cash just runs out?
Hmm.
I mean, picture this. You're a business owner. You've just shipped a massive order. You have a stack of invoices on your desk worth, I don't know, millions. But your bank account is hovering near zero.
Right, the classic liquidity trap.
Exactly. You need to pay salaries tomorrow, a bank loan. That'll take weeks to process. What do you do?
You're profitable on paper, but you're broke in practice. And that is exactly where, the invisible engine of trade comes in.
Right. We are talking about factoring, and I know factoring sounds like the kind of dusty financial jargon that makes your eyes glaze over.
It really does.
But it's actually a lifeline. It's the difference between a business surviving to fight another day or folding because they couldn't wait 90 days for a client to pay up.
Precisely. It's not just about lending money. It is about monetizing your receivables. You're selling your invoices today to get cash now, rather than waiting for some point in the future.
And today, we are looking at one of the giants in this space in Turkey.
We are.
We have got the 2025 annual report for Garanti Factoring right here, and let me tell you, the numbers in this thing, they are eye-watering.
Wow.
We are seeing things double, triple. It's a wild ride.
It certainly is a fascinating report, especially when you look at the macroeconomic backdrop of 2025. But before we get lost in the billions, we really need to understand who we're actually talking about.
Welcome.
Thank you. It is good to be here.
Let's first get to know the company a little. So, Garanti Factoring. The name sounds familiar, obviously, because of the bank, but they have been around for a while, haven't they?
They have. They were actually founded back in 1990, originally under the name Active Finance.
Oh, Active Finance. Okay.
Yeah, and it wasn't until 2002 that they officially rebranded under that Garanti umbrella that everyone knows.
And they're headquartered in Pendik, Istanbul. Now, when I think of a company generating over 10 billion TL in revenue, I picture, a massive campus, thousands of employees, maybe a company cafeteria the size of a football field.
Yeah, you'd think so.
But that's not really the case here, is it?
Not at all. This is a service provider, pure and simple. They don't have factories or warehouses. They operate through just 11 branches across Turkey.
11 branches.
And looking at the 2025 report, their total workforce is only 122 people.
Wait, 122 people?
That's it. And that's up slightly from 120 the previous year.
That is incredible efficiency. I mean, just do the math. If we look at their total assets, which we will get to, that's hundreds of millions of lira managed per employee.
It really highlights the nature of the business. It's about capital allocation and risk assessment, not, heavy lifting.
Right.
They don't have domestic or international subsidiaries or joint ventures clogging up the org chart. It is a very streamlined, very focused operation.
But they do have some very big parents.
They do. This is a classic subsidiary structure. Turkey Garanti Bankastic owns a massive 81.84% of the company.
Wow.
Then you have Turkey Eşirgat Kredi Bankastic with about 9.78%.
Which leaves very, very little for the rest of us.
Exactly. The public float, the shares actually traded on Borsa Istanbul, is only 8.38%. So while it is a public company, the control is very, very firmly held by the bank.
Speaking of control and governance, I was scanning the report for the board of directors. Usually we like to look at the diversity there, the gender ratios, the specific names, but the report was a bit thin on those specific biodata details this year.
True. The source text didn't explicitly list the board composition or a gender breakdown, which is, something investors usually look for these days in terms of modern governance.
Yeah.
However, we do know the cost of the leadership.
Right, the bill for the key management.
Yes, executive compensation. For the year 2025, the benefits provided to key management totaled 43.3 million TL.
43.3 million. And how's that compare to last year?
It's up from 41.9 million TL in 2024.
So, a modest raise for the bosses. Okay, let's unpack what they actually do. We said factoring, but how does Garanti Factoring position itself in the market?
Well, simply put, they buy a company's accounts, receivable, their invoices, at a discount. They give the company immediate cash, and then they're the ones who collect the full amount later. Their position is unique because they are backed by a Tier 1 bank.
And that brings us to the competitive environment. It's a crowded market, right? I imagine there are a lot of players.
Extremely crowded.
Yeah.
But being part of the Garanti BBVA ecosystem is a massive moat. It's a huge advantage. It gives them access to cheaper funding and a built-in client base that a standalone factoring company just wouldn't have.
So if we were to do a quick SWOT analysis based on this report, what does that look like?
Okay. Strengths, Clearly the backing of Garanti Bank
Right.
and just huge capital access
Right.
weaknesses. They're heavily reliant on debt funding to operate, which we'll see very clearly in the liabilities. Opportunities. Well, inflation.
Inflation is an opportunity. How does that work?
In this business, yes.
Yeah.
As prices rise, the value of the invoices they finance goes up. So it naturally increases their volume without them having to actually do more work, so to speak.
Got it. And the threats?
The rising tide of non-performing loans, or NPLs, and of course just general economic volatility. When the economy shakes, businesses stop paying their bills.
And that's the nightmare scenario for a factoring company.
That's it.
Okay, that sets the stage perfectly. Now we can move on to our analysis.
Let's dive into the numbers.
So we're comparing the full year of 2025, ending December 31st, against the previous year, 2024. But there's a huge elephant in the room regarding how these numbers were calculated.
A massive elephant.
No.
We have to talk about inflation accounting, or rather, the lack of
Grab it.
Yes. Despite the high inflation environment in Turkey, the regulator, the BDDK, decided not to apply inflation accounting standards, specifically TMS 29, for this sector in 2025.
So what does that mean for someone listening?
It means we are looking at nominal growth. The numbers look massive, doubling, tripling, but a significant portion of that growth is just the currency losing value. If you don't keep that in mind, you might think the company grew 100% in real terms, which just isn't true. It's like measuring your height with a ruler that keeps shrinking. You look taller, but you haven't actually grown.
That is a great way to put it. So, grain of salt with every number we discuss. Let's start with the income statement. The top line, revenue.
It exploded. Factoring income hit 10.47 billion TL.
Wow.
And compare that to 2024, where it was 5.63 billion TL.
That's nearly double.
It is.
And most of that is just interest.
Almost all of it. Interest on factoring receivables accounted for 10.3 billion of that. They're essentially just collecting interest on the money they advance to businesses.
But, and here's the catch, to lend that money, they had to borrow it first. And borrowing money wasn't cheap in 2025.
No, it was not. If you look at the finance expenses, the cost of doing business skyrocketed. They paid out 6.76 billion TL in finance expenses.
And that's up from, what, 3.2 billion the year before?
Exactly. It's a mirror image. Revenue doubled, but the cost to get that revenue also doubled.
It's like they're shoveling coal into the engine twice as fast, but the coal costs twice as much now.
That is a perfect analogy. They are running faster, but the friction, the interest rates they have to pay is intense. Most of that 6.7 billion went to interest on loans used.
But despite that huge expense, the bottom line still looks healthy.
It does. Net profit for the period came in at 2.13 billion TL. That's a solid increase from the 1.44 billion they made in 2024.
So they are making money. The machine works, but let's look at the balance sheet. This is where you see the sheer scale of the operation.
The growth here is staggering, at least in nominal terms. Total assets jumped to 33.5 billion TL.
And it was only 13.3 billion the year before.
Yes. The company grew 2.5 times in size in just 1 year.
That is wild. And I'm guessing most of that asset base is just invoices.
Correct. Factoring receivables make up the vast majority. That line item increased to about 32.2 billion TL. It shows they're financing a lot more trade, or, again, that the value of the trade they're financing is just inflated.
Let's talk cash. Profit is one thing, but do they actually have cash in the bank?
They do. Cash and equivalents at the end of the period stood at 87.4 million TL, up from 54.4 million.
That seems kind of low. I mean, for a 33 billion TL company.
It is tight, but remember, their business is to push cash out the door. If they are sitting on cash, they aren't making money.
Yeah.
But look at the operating cash flow. It was a positive 404 million TL.
But that's lower than the previous year, right? In 2024, it was, what, 2 billion?
It is significantly lower. And the reason is clear in a cash flow statement. A massive outflow of cash used to buy new factoring receivables. They poured 19.5 billion TL into buying new invoices. They're just reinvesting everything into growth.
So they are betting on themselves.
You're betting on the market.
Okay, so to fund all this buying of invoices, they had to borrow. We mentioned the finance expense, but how much debt are they actually carrying?
Loans borrowed stands at 27.6 billion TL.
Up from 9.7 billion. That is a huge jump.
They leveraged up significantly. They are borrowing very heavily to capture market share. And it's interesting to note, most of that debt, 24.1 billion TL, is in Turkish lira.
Okay.
They have some foreign currency debt, about 3.5 billion TL equivalent, but they're mostly borrowing in local currency.
Which makes sense if your income is largely in TL. You don't want a mismatch there.
Yeah.
Now let's look at shareholders' equity. What's left for the owners?
Equity increased to 5.3 billion TL, up from 3.17 billion.
Yeah.
The interesting part here is that the paid-in capital remained flat at 397.5 million TL.
So the growth in equity is coming from just from keeping the profit.
Exactly. Retained earnings, they added the 2.13 billion TL profit from this period directly into equity. They're building a fortress balance sheet from the inside.
Okay, now we get to the part I love, the footnotes, the stuff that gets buried in the fine print. You found some red flags here.
I did. The first and most critical one is the NPL's non-performing loans. In the report, these are listed as follow-up receivables.
These are the invoices that aren't getting paid, the headache file.
Correct. And this number jumped. It went from 121 million TL in 2024 to 426 million TL in 2025.
That is nearly a 4 times increase.
It is, and while it's still a small percentage of their total 32 billion in assets, the trend is worrying. It suggests that while they're growing fast, the quality of the debt they're buying might be deteriorating.
Or their clients' customers are just struggling to pay.
Exactly.
And related to that, I saw something about write-offs. They actually erased some debt completely.
Yes. There was a regulatory change mentioned in the accounting policies that allows them to write off receivables that are considered lost in nature. Basically, hope is lost.
So they just give up.
They do. They wrote off 62.8 million TL this year.
And last year.
0. So this is a new mechanism they're using to clean up the books.
That is significant. It means the bad debt situation might be slightly worse than the NPL number alone suggests, because some of it just vanished from the balance sheet.
Precisely. If you add the write-offs to the NPLs, the picture of credit quality is definitely degrading.
Now, we mentioned this is a family business with Garanti Bank. How deep do those ties go in the footnotes?
Oh, very deep. It's a whole web of related party transactions. For instance, they have 919 million TL in loans just from Garanti Bank International NV.
And they are paying for it, I assume.
Oh, they are. They paid 1.19 billion TL in interest and commissions to Garanti Bank International NV alone, and they keep their cash, about 28 million TL of it, sitting in Garanti bank accounts.
So money flows from the subsidiary back to the parent in the form of interest, and then the parent lends it back. It's a closed loop.
It creates efficiency, for sure, but it also highlights that their cost of funds is somewhat determined by their parent-company relationships. It's not an entirely open market dynamic.
And finally, the tax man.
You can't escape him. They paid a hefty corporate tax bill of 922 million TL.
Almost $1 billion in tax. That is a serious contribution.
It is, and it reflects the high nominal profits. Inflation drives up the numbers, and tax is calculated on those nominal numbers. It drains cash that could otherwise be used to bolster equity.
So what does this all mean? We have looked at the massive growth, the rising costs, the bad debts creeping up. If you look at this through the lens of a rocket ship, the engines are burning hot.
It really is a rocket ship of nominal growth. Revenues doubling, assets growing 2.5 times. If you just look at the headlines, it looks like a company that's taking over the world.
But
as an analyst, I have to look at the fuel mixture. This growth is heavily fueled by inflation and massive borrowing. The core business is healthy. They're clearly facilitating a lot of trade. But the rising bad debts, those NPLs quadrupling, that is the storm cloud.
it feels like they're running faster and faster.
They are. And when you are highly leveraged, I mean, remember, they borrowed 27 billion to hold 32 billion in assets. If the market turns, or if those NPLs spike further, that leverage cuts both ways. Hard.
So for the retail investor listening to this, what is the takeaway?
I would say this is a pure play on the Turkish trade economy. If you believe businesses will keep producing and crucially keep paying their invoices, Garanti Factoring acts as a multiplier on that activity.
They make money on the volume of trade.
Exactly.
But if the economy stalls,
If the economy stalls, or if a chain reaction of defaults starts, those NPLs become dangerous very, very quickly. You are really betting on the solvency of the entire Turkish supply chain.
that is a high-stakes bet. But looking at 2025, so far, the bet has paid off to the tune of 2.13 billion TL in profit.
Indeed, it is a profitable, high-octane machine, provided the road stays relatively smooth.
Well, there you have it. The invisible engine of commerce, stripped down and analyzed. If you enjoyed this deep dive, please do hit that like button and subscribe. It really helps us get these insights out to more people.
And if you want to support the channel directly and help us keep making these videos, please consider evaluating our membership options. It allows us to keep digging through these reports so you don't have to.
Or you can drop a super thanks if this episode gave you that aha moment.
We always appreciate the support.
Before we go, I want to leave you with a thought. We saw the numbers double, revenue, assets, everything up. But remember what we said. Inflation accounting wasn't applied.
That is the key.
So here is the question. If we looked at these numbers through the lens of real purchasing power, if we adjusted that $2.1 billion profit for the cost of bread or electricity in 2025 versus 2024, would we see a growth story? Or would we just see a company running twice as fast just to stay in the exact same place?
That is the trillion lira question, isn't it?
Thanks for listening. We will catch you on the next deep dive.